This is level 1 of the CFA program. Topic on economics and the reading on Introduction to Geopolitics. This is a new reading, and I have a handful of thoughts before we get started on the LOSs and the slide deck. I want you to think about the top-down approach to economic analysis, where we take a look at the entire economy. So we look at variables like inflation and interest rates and oil prices, and then we work our way down. Well, this reading is really just kind of provides us with a little bit more granularity. There's a cool word that people have been using lately. Inside of this macroeconomic analysis, where part of that is economic risk, but the other part of it is political risk. And so this reading is really just kind of a layer inside of this macroeconomic analysis. The other point I wanted to make is that if you go to the CFA webpage, you can look at a book that's published by a guy named Clement, and it's called Geoeconomics. And I happened to read the introduction and a couple parts of this. It's really, really cool stuff because it emphasizes a lot of what I have been saying in all of these videos. The Institute doesn't expect us to be professional accountants or lawyers or tax experts, but it expects us to be able to have colleagues who know and can provide us with that kind of support. Well, this Clement guy in this book, he says something like, geopolitics and geoeconomics is dominated by politicians and international relations experts. And he goes into some detail describing how politicians and international people are not experts in investing. And so he kind of builds on this theme that I've been saying, that the Institute, they don't want us to become political scientists. They don't want us to become international experts, but they want us to have a foundation to be able to ask the right questions to the right people so that we can get the correct answers to be able to apply this macroeconomic analysis to the policy statement for our clients. And so with that, let's go to these 4 learning outcome statements. And I think they increase in importance as they go on. We'll talk about cooperation versus competition. We'll talk about globalization. And then tools and their impact. And then the final one is probably the most important one, I think. How is its impact on investment? And let me go back to that book that the Clement guy wrote, where he says something like, look, the United States in, what year was that, 2002, went to Afghanistan and Iraq. And he says, for investors, the Afghanistan invasion was almost a non-event. Iraq, it was a short-term event that really didn't have any long-term implications. And so I think this is really a cool reading because what it does is it broadens our attention. And it deepens our attention into this concept of political risk. And now we add geography term to political risk so that we can be better prepared to help our clients. Now, this reading has lots and lots of definitions, some of which you probably know. And so this is a little bit of a review. But there are some terms in here that lend themselves to great exam questions here. All right, here's the definition of geopolitics, how geography influences national and international relations. And so you might think, okay, I need to be an expert on international relations. But the answer to that is probably not an expert, but you need to have a foundation so that you are aware of national and international relations and what their impact is on the investment community. All right, so this is called geopolitical risk. Remember how I always define risk in all of my recordings as variability in outcomes. So remember, systematic risk is variability in stock returns due to changes in economic factors. So geopolitical risk is going to be variability in outcomes. So maybe variability in portfolio values due to geopolitics. So there's some examples, changes in legislation. So that's almost entirely political. So boy, it'd be nice if we have some colleagues who are experts in political science so they can help us predict the outcome of a future election, which then will have some implication about legislation. I mean, here's an example that I've used in class, and maybe you've heard me say this in a recording. Suppose that for some reason the Pennsylvania legislature in the United States says something like, you know what, we're going to outlaw the sale of chocolate. And so Milton Hershey, who lives right in the middle of Pennsylvania, all of a sudden has this product line that he sells all over the world, is no longer allowed to sell it in Pennsylvania. I mean, that's a silly and a crazy example, but you can see that if I give you an example in the extreme, then you might say, okay, well, what about changes in legislation for trade between and among the mid-Atlantic states, or trade with Pennsylvania and Canada? Boy, this is going to impact any client that we have that lives in Pennsylvania. Other examples include a terrorist attack, and things like natural disasters, and then market volatility. Of course, you can't ever eliminate market volatility, because, as we know, market volatility inside of the United States, which could be measured as simply as let's say the standard deviation of the returns of the S&P 500 index. But let's compare that to maybe the returns on the Ukraine stock index in early 2022. So there's lots and lots of differences in volatility. And so the volatility in one country probably is going to have some correlation to the volatility in another country. All right, the first part of this reading focus on national governments and political cooperation. So it makes sense then that there are some well-known actors, is what the reading refers to these as. So these are just individuals. Think Twitter and the takeover attempt by Elon Musk. There's an individual who has some influence in geopolitics, as it got lots and lots of politicians from this side and from this side involved about whether or not that was a good idea. Organizations could be almost anything. I mean, I like to think of organizations in terms of their ability to impact the surrounding regions and also impact society in general. You may have heard me talk about the African Development Bank, who does a great job in trying to bring, just regular old stuff like water and healthcare and all that kind of good stuff. So organizations, and then of course national governments, which in most cases, but not all cases, are elected leaders. And so, of course, the politics and the economics of these decisions cannot be separated. And that's why the Institute emphasizes monetary policy on this side, which is one side of the government, and then fiscal policy on this side, which is another side of the government. Some of these are elected, some of them are not, but their impact on the economy and therefore on the investment policy statement, of course, cannot be ignored. And with this reading, it's now being emphasized. So what do we have in that last diamond point down there? Economic, national security, social, cultural factors, and non-state actors. Non-state actors are, of course, multinational corporations who have been getting involved more and more so in the political environment and the social justice movement. And so they can become not just operating in the backgrounds, but they can become influential entities. Of course, state actors, presidents, and political parties. Yeah, that makes perfect sense. All right, I'm guessing that you probably don't need me to tell you the difference between a cooperative form of government and the viewpoint about interactions. And so cooperative form means they have a common goal. And that common goal could be kind of summarized in a formal manner, like maybe NAFTA was during the President Clinton years, or it could become something that's less formal, less contractual, that has to do with agreements over regulations and commerce and other kinds of things. Non-cooperative nation has erratic, arbitrary policies, limits cross-border trade. Yeah, that makes perfect sense. Boy, we could get through this slide in the next one probably pretty quickly here. Reasons or motivations for cooperation, national security interests or military interests. Of course, September 11th, that was, pretty much a wake-up call. I mean, it wasn't the beginning of terrorism, whether it's a global terrorism or domestic terrorism, but it certainly caught the world's attention. And so, of course, we're now focused on this in the last couple of decades. Economic interests, I mean, this makes sense when you have international trade. Remember, we talked at length in one of those economics readings about comparative advantages and how it makes sense for one country to do this and another country to do that, and then they trade and everyone's better off. Oh boy, resource endowment. Some countries are blessed with lots and lots of resources. Here in the United States, we have almost everything. We don't have everything, but we have almost everything. Other countries are not so fortunate to have been positioned in an area where they don't have as many or as diverse natural resources as the United States does. In class, I always give the example of the North Pole, and I say, what does Santa Claus and his elves have up there in terms of natural resources? And outside of snow, I'm not quite sure what they have up there, but that's why you don't trade with Santa Claus, because he probably doesn't have anything to offer. Standardization. I'm going to go back to the success in 1848, what used to be called the Chicago Board of Trade, now the Chicago Mercantile Exchange. And what these individuals did is that they took a really, really awesome forward market and they standardized it and called it a futures market. And now we have these super derivative contracts that are available today, all because 1848, they standardized the terms of those particular contracts. And so standardization is another form of a tool that allows countries within its boundaries and outside of its boundaries to have some kind of regulatory cooperation, so that there are some standards, so that, let's suppose that here I am in the United States and I have a Honeycrisp apple tree in my backyard, and I want to trade with some Canadian firms, and I get up there and I have all these Honeycrisp apples, and they say, well, wait a minute, these have too much red on them, or they're not juicy enough, or. And so the standardization will then facilitate that trade. And then there are other cultural considerations, and I think this is what's really happened over the last decade or two here in the United States and globally, about trying to find similarities, not just politically and not just culturally, between and among different countries, but using those similarities to help the process of globalization. Role of institutions, I said this earlier, they may be structured formally, like the African Development Bank, or informally. Notice there's a term in there like a university, and of course universities are well known for trying to attract not only students, in the local or the region or the national areas, but also international students. All right, how about a hierarchy of interests? All right, so this is interesting, because what we're trying to do here is we're trying to say something like, all right, let's do some ranking. And we know all about ranking. Let's just use the example of trying to determine what the default risk is on a bond. And so we have these ratings agencies that, they go from AAA all the way down to a bond that is rated D, which is one that is in default. So if you know that a bond is rated, let's say, triple B, you know exactly what at least you should know exactly what its default risk is going to be over the next time period, whatever that time period is. So what we're trying to do is we're not ranking based on default risk, but we're going to rank and call this a hierarchy based on its goals and ambitions. And so, part of this would be something like, let's suppose that I'm the chairman of the Fed here in the United States, and I say something like, look, we're going to pursue policies that promote the sale of chocolate bars. And so what that does is that's going to result in decisions that the Fed makes that are going to probably increase the demand for Hershey chocolate bars. Now, that's another super silly example, but it illustrates the simple fact that, boy, if that's the primary goal of the Fed, then there are other goals that are below it or beneath it. So what are some reasonable goals here? With our Fed, we say something like, we want inflation to be reasonable. We want the money supply to grow at a reasonable rate. We want unemployment levels to be, not as low as possible, probably not zero, but something relatively low. And so we rank those, including things like, the size of the national debt, how much we pay our retirees, what our position is on national borders. So we rank all these and we say something like, all right, these 6 are essential and these down here at the bottom are non-essential. And so notice that third arrow point. And this is probably the great exam question. When there's a conflict of interest between goal number 2 and goal number 7, if one is essential and one is non-essential, then we go ahead and pursue that goal at the top. The reading does mention these trade agreements. I said something about NAFTA earlier, and I'm always a big fan of Milton Friedman, who, those of you who know Milton Friedman, you should know, all of you should know who Milton Friedman is, a great economist, and he was always in favor of international trade. So you compare that with some kind of an armed conflict, and which one's more important? Well, probably national security takes precedence over a trade. But then again, this is why we elect these leaders and put these really smart men and women in charge of the country so that they are able to rank these, to determine the hierarchy, and then to make those decisions. Yeah, so here's the problem, then. It becomes more subjective depending on the people in government. And we've heard this term probably since the year 2000, when Bush and Gore had a really close election here in the United States. There were lots of people who used this term, who maybe created this term, that, do you remember this? And we hear it all the time today. Elections have consequences. And what that means then is that the individuals, or the groups of individuals in power, then can bring their own kinds of thoughts. And that's what this bolded word subjective means in that first teardrop point. All right, so healthcare, this is a super big problem throughout the world. Compare that to military strength. There's always a fight here in the United States. Fights might be a better word, might not be the perfect word, but there's disagreement between how much should we spend on national defense, how much should we spend on the Army and the Navy, etc., versus providing healthcare. And of course, we lived through this in 2020 with COVID. This third teardrop point is an interesting one. I think it's probably a really good exam question if it were not just reduced to a multiple choice. If you could kind of write this in an essay, the shorter the cycle, the less longer term risks are probably prioritized, and climate change falls into that category. All right, how about globalization forces? All right, so we know what globalization is. It simply means that you have countries here and here and here and here, and they interact, and are they integrated? They might be. They could interact without being integrated, but the more they interact, then those roots kind of, mesh together, and then all of a sudden they're integrated, and you can't segregate those roots because they're intertwined. Now, I do like this concept, this definition of microeconomic globalization, in which you have some parts made in this country, some parts made in this country, some parts made in this country, and then all those parts are shipped to, let's say, a fourth country to build that final product. So remember that definition, microeconomic globalization. But of course, there are these concepts of nationalism and anti-globalization, in which the country's own interests are promoted at the expense of anybody else out there. This probably became extremely popular after the President Obama years, and then during the President Trump years. Now look down at the bottom under features of globalization. And so what does this mean? Cooperation, capital flows, currency exchange. All right, so remember, this is why we did all those different kinds of balances when we looked at, kind of the balance sheet of a particular country. So remember all that stuff that we talked about before. And then cultural and information exchanges, that leads to globalization. And I'm going to go ahead and state what is, to me, is probably the obvious, because I'm such a great sports fan and such a great rock and roll fan. So just think about the Beatles. Hopefully you guys heard of the Beatles. The Beatles come to the United States from Liverpool, and they, these are really cool guys. They have this cool music, and they're good musicians, and people pretty much have coronaries when they play live. So clearly, this is an example in which the entertainment industry, and of course the sports industry as well, take a look at someone like, probably the two original global superstars, Muhammad Ali and Arnold Palmer. They brought boxing and golf to countries throughout the world. And then this leads to an identification that, even though some people might be living here and some people might be living over here, we have a commonality, we have a common bond. And if we realize that common bond, then that leads to all this other stuff that we're talking about. Notice that last arrow point: new markets and skills. All right, how about the relationship between globalization and geopolitics here? All right, so we talked about this before: capital flows, currency exchange, trades, cultural. All right, so that goes over here. And what is that? That's almost the opposite. That's almost the opposite of nationalism, where we limit trades, we regulate capital flows, we limit the currency exchanges. And so what's the motivation here to globalize? The reading talks about an increase in profits, but I'm always going to go ahead and couch that by saying an increase in profits. I'm okay with that. I'm okay with that sentence, but let's put a comma and not a period after that. Let's say comma, and also an increase in operating cash flows, or an increase in free cash flow. So remember all that stuff that we talked about. Remember, we had free cash flow to equity, free cash flow to the firm. Remember all those formulas as it applies to globalization. And of course, the recent example with COVID is the supply chain, right? We had all these supply chains interrupted. In fact, one of my close friends runs a business here, and his business depends on buying parts from about 7 or 8 different countries. And whenever I talk to him, he says, boy, oh boy, I can't buy this thing here. I tried there and there and there. Nobody has it. And so this was the result of this supply chain disruption. And I will point out that it did lessen for him and for all of us as time went on. Access to markets. You guys that watch my videos will know that I do this regularly. In the academic world, we call this spanning. It used to be, let's go back 50 years or 70 years, it used to be that investors would, buy some stocks, buy some bonds, and have some emergency cash. And that was kind of it. But now we have spanned. So we increase the access to not just different markets, but then different types of securities within those markets. And then with this globalization, those markets, which at one time were emerging markets, now can become developed markets. And then there are these things that I think of as these synergies. You remember in our merger and acquisition reading, we talked about taking one firm that was worth 1 and merging it with another firm that was worth 1, and all of a sudden the newly merged firm is worth 3. We call those synergies. The reading here is calling these intrinsic gains. And I always tell my students when we do this merger and acquisition chapter, I say, look, you have some really smart men and women in this firm, and they do stuff one way. And then you have really smart men and women in this firm, and they do stuff a little bit of a different way. And you put these really smart men and women together, and they say, oh, you do it that way. That's pretty cool. We do it this way. Let's go ahead. 1 + 1 = 3. It's hard to argue with math, isn't it? How about the cost of this? All right, we're in the middle of an economics lecture, so we can't talk about the marginal benefits, which is what we just did, without talking about the marginal costs. All right, so the simple fact is that when you have this, let's say, international trade, it is going to be beneficial for some people, but it's going to harm some other people. So the question is, does it raise the standard of living for everyone? And sometimes it does, sometimes it doesn't. And then the second component here is that they're lower ESG standards. And so what might happen is that there might not be an emphasis on, let's say, anti-pollution. There might be a way in which we can only increase the standard of living for a particular country if they burn, let's say, cheap coal. And until they get to a certain standard, then they can't really worry about climate change as much as the rest of us. So there are probably different operating standards. There are probably different hierarchies, etc. Political consequences. Those of you who pay attention to the Wall Street Journal or anything else, and I say this regularly, if you don't read the Wall Street Journal, that's my advice. Read the Wall Street Journal every day. Interdependence here with each other for resources. And so, let's suppose that, I'll go back to my example, I'm a Honeycrisp apple farmer here in the United States, and I'm trying to trade with a Canadian forester, because what I want to do is I want to trade my apples for some lumber. I want to build a house in my backyard. And so, boy, what happens is that my apple production then is a currency, so to speak, right? I'm trading apples for lumber, and that lumber is a currency, so to speak, for the Canadian firm there. And so what are we doing? We are trading based on the value of the apple per lumber. And so suppose that I have a disruption in my supply chain in which I don't have any fertilizer. So I can't fertilize my trees, so my apples are smaller and less juicy. And so when I go to trade in Canada, I get a 2-foot 2x4 instead of a 10-foot 2x4. All right, so this is important here about this interdependence and supply chain disruptions. All right, how about these actors here? I'm guessing that you know about these archetypes. So we have an autarky, nations with little or no foreign trade. A hegemony, this is nations, they serve as regional or world leaders, but they try, and sometimes they're successful in exercising dominance there. And you have the other two here, multi and bilateralism, where what we can do with a multilateralism is that we just trade with lots and lots of different countries. And bilateralism is that when you have an agreement with two nations. And of course, historically, bilateralism was the first type of globalization for countries that were side by side. I mean, it makes sense, if there's a foot that separates the geography boundary between the two countries, you would think that they're going to trade, and then so that bilateralism, so then you have a country on this side of you and a country on this side of you. Well, you're trading with those two people, and then north and south, right, if I'm doing it that way. And so now you're trading with 4 bilaterals. I'm pretty sure that's not the right term, but anyway, so now you got 5 countries there. And so it makes sense then for those 5 countries to be multilateral. All right, how about some geopolitical tools? So national security tools, so access to resources and borders. Just think about September 11th, their national security tools. Financial tools, this is exactly what we've been talking about, not only in the macro, but also the microeconomic readings here. But of course, they snoop out into all the other different topics, including the economic tools that we just described. Now, there are multi-tool approaches here. They are intertwined. So cabotage is a really interesting kind of a concept here. Make sure that you understand the definition of cabotage, because one of the 15 or 16 end of reading questions is really just a definition to be able to understand what cabotage is. And so think about this. If here we are in the United States, and we do lots of stuff here in the United States, and we have airlines that fly from, let's say, the East Coast to the West Coast, and these airlines are all operated by U.S. companies, right? And they're approved by the U.S. government. We probably don't want other countries coming in and having flights that go from one part of the country for national security interests and safety interests. And so regulation here of this cabotage is included in multilateral trade agreements. Now, the airline is an extreme example. Most countries don't allow that. But what about ships? Can here in the United States, can a Canadian ship come from Canada and land in New York and then go ahead and land in Philadelphia? Not Philadelphia. Well, there's a little river in there. They could come and land in Philadelphia. And then can they go all the way around and land in San Diego? And so, boy, you have this maritime right from one country to land there, and trucking and railways. Those are all those same kinds of things. Look at that third diamond point. Some countries may restrict this with certain sensitive economic subsectors. And so that's what I'm talking about. It's probably okay to have an Italian firm have a taxi cab service. Do we even have taxi cabs anymore with Uber? Yeah, and so look at the last one here. As countries collaborate more, the less likely. That makes perfect sense. All right, this is leading up to great exam questions here. Difference between and among event risk, exogenous risk, and thematic risk. Think about event risk are risks based around a certain event, which may or may not be predictable, like an election, political anniversaries, the enactment of new laws. Boy, there are lots and lots of examples of event risk. Exogenous risk, think about hurricanes or earthquakes. What else there? Nations' willingness to cooperate. Yeah, that makes perfect sense. Thematic risk, this is terrorism, what we talked about before. Now, the next question is how do we measure these things? And one of the fascinating sentences that I read in that Clement book that I was telling you about earlier was that these political scientists and international relations experts kind of have the thought that it's impossible to quantitatively measure these risks. And you can only do it qualitatively. And he has a sentence written in there that says something like, this is nothing could be further from the truth, or it's hogwash or something. And I thought, you know what? Here's a guy who is doing all the right stuff. He wants to quantify risks in the traditional and maybe non-traditional ways that we want. So how do we do this? Likelihood that it will occur. And so you think about this. You can use all the quantitative methods, topics that we've talked about here in level 1 that you'll expand in level 2 and in level 3. So likelihood that it will occur, this has all the stuff to do about not only possibility that it will occur, which probably doesn't have a lot to do with probability, but then the probability. So you try to quantify it by saying, okay, there's a 1 in 100 chance of an event occurring, or a 1 in a 10,000 chance of an event occurring. That's why things like expected exposure and value at risk, these are super important tools to quantify these kinds of risks. And then this is what this Clement guy was saying about the U.S. involvement in Afghanistan, that it was almost a non-event. So let's go ahead and decide what's the next step in a non-event. It's a little event or a moderate event or a big event, and how quickly does it get there? All right, so velocity of its impact. Now, remember that we learned that Eugene Fama in 1970 or so taught us about efficient markets hypothesis, where he said something like, boy, when relevant information about a particular company changes, that impact will be instantaneously felt on the floor of the New York Stock Exchange. However, these geopolitical events may or may not be instantaneously impacted and reflected on the floor of the New York Stock Exchange until we can try to figure out what their short-term impact, their medium-term impact, and their long-term impact is going to be. So remember, look in that middle bullet point there, high velocity and low velocity, depending on, boy, look at what we have in that third bullet point there, environmental, social, governance, all those other kinds of things that ultimately impact the asset allocation, probably the tactical asset allocation, but also is there going to be a change in the long-term strategic allocation? And then the size and the nature of the impact. Is it limited to just this area? If you have a hurricane that hits into North and South Carolina, clearly that's going to impact those businesses around that area. Is it going to have an impact on the businesses in California? Well, the answer to that question is, well, what's the supply chain between those firms in the Carolinas versus what they ship westward out to California? Now, one way to quantify this, of course, you should be thinking about it, is under scenario analysis. You might think, let's try something like a correlation or regression. And well, remember that when we use those things, we're automatically assuming linear relationships. But this geopolitical risk is probably not linear because it's way more complex than just 2 or 3 variables interacting. And so therefore it's difficult to forecast. So what you do is you use sensitivity analysis and scenario analysis. And we've been doing this in our quantitative methods discussion. So let me go ahead and remind you, at the risk of offending you, is think of a scenario analysis as an Excel spreadsheet where you start with the portfolio value today for your client. And then as you move out in each column in the Excel spreadsheet, you have different types of possible outcomes. And so this looks like a tree. In level 2, we're going to talk about an interest rate tree to price fixed income security. That's going to be a super fun conversation. But I'll probably mention scenario analysis when you take a look at that recording. And so what you do is you say, and here's the extreme, the scenario. Here's the best case scenario, and then here's the worst case scenario. And then you decide how many scenarios you want in between the worst and the best case scenario. And you do this out for multiple time periods, and you do it for multiple geopolitical risks. Like for example, here in the United States, we're going to have a presidential election in 2024. So you could run a scenario analysis that says something like, okay, suppose the Republicans win the presidency in 2024, then this is what likely will happen. Suppose the Democrats retain control of the White House, this is what likely will happen. And then inside that scenario analysis, you can pick different individuals who might bring their own sense of subjectivity to the White House, and you could run a scenario analysis if Donald Trump is elected, or if Joe Biden is reelected, or if Kamala Harris is elected, or if I'm elected. You could run that scenario analysis. Now, of course, that probably has 0 possibility and 0 probability, but you get the sense of, boy, this scenario analysis can be quantified and it can be very complex. Now look at the bottom that bottom diamond point. Boy, this is so important. And I love the way the Institute, especially in the newer readings, emphasizes the policy statement. So what do we have in the policy statement? We have a risk and return objective for every client. We have a set of constraints that includes the time horizon, but it also includes liquidity constraint and legal and regulatory constraint and a behavioral constraint and unique circumstances constraint. And so you lump all these things together and you say something like, look, under this scenario, let's just suppose a President Biden re-election in 2024. Under that scenario, the portfolio, which is worth $1 million today, could be worth these future values. And so essentially it's a time value of money kind of a conversation in which you're trying to predict the future value of your client's portfolio. Because remember, in 4 years, your client wants to do something. Let's suppose that's, pay for their children's college education that's going to cost, let's say $250,000. And so, you want to make sure that you have a minimum of $250,000 in year 4 or 5, whatever year I said. How about tracking risks based on these signposts? Oh, let me go ahead and just, did I mention this here? A signpost, an indicator, a piece of data. So, an indicator. What's an indicator? Maybe it's oil prices. Maybe it's inflation. Maybe it's an election. Maybe it's a drop in the construction of wind turbines because of improvements across the supply chain that is going to lower the cost of productivity of wind farms. All right, so an indicator, a piece of data sometime, inside of that indicator, or an event, which could be almost anything, which going to suggest an increase or a decrease in likelihood. And so those signposts, think about this scenario analysis with this Excel spreadsheet. Think of this signpost as a highlighted cell somewhere in those future time periods, 1, 2, 3, or 4, and there's a highlighted cell that says something like, oh wow, we need to think about this. This is a major event, a major indicator, a major piece of data. So what about these trading risks based on these signposts? So you say something like, all right, my client's portfolio is worth $1 million and the client needs $2 million in a couple of years, whatever that is. And I've got these signposts here. So maybe I'll change my tactical asset allocation. Maybe I'll reallocate my resources to an emphasis on technology versus healthcare inside of that particular asset class. So how do we deal with these tracking risks or tracking errors? And so, I'm just going to go ahead and summarize this by saying something like, it all depends on the model, right? We talk regularly about model risk in quantitative analysis. So if your scenario, let me go back here quickly. So if your scenario analysis is, how about if I just call it this, reasonable, that you have reasonable signposts, you have reasonable future values for the portfolio based on reasonable assumptions. I mean, you're not going to say something crazy like, okay, in year 2, the aliens are going to come down and they're going to eat up all the chocolate in Hershey, Pennsylvania. Therefore, I'm going to sell my Hershey stock in the portfolio based on future aliens. Boy, that was really a silly example, wasn't it? All right, so this is called model risk, and that's what really this 4th embedded bullet point. They help investor differentiate noise and actual risks, and this requires some trial and error. So there's going to be some tracking error in all of this, and it's not going to be perfect. And that's why one of those earlier slides, we reflect what the reading says, that this is complex. However, just because it's complex doesn't mean that we're going to go ahead and stick our head in the sand and hope the waves don't crash over us. All right, how about manifestations of these geopolitical risks? Well, we talked about this. So asset prices changes, but not only asset prices changing in one direction, but it manifests itself into increases in market volatility. So if you think, let me go back here real quick. If you put a bunch of different signposts and you attach a higher probability to those signposts over time that are going to increase the likelihood that your client's portfolio is going to reach that target future value, well, maybe you're going to change your plan. Maybe you want more volatile stocks or bonds. Maybe you want less volatile. Maybe you're going to move over to commodities. Maybe you're going to move into derivative securities. Notice that second one there. Low velocity risks are more prolonged. All right. So, those high velocity risks are probably going to be impacted fairly quickly, but low velocity, maybe that takes time. I think I said this to you guys in an earlier recording. When I was in graduate school, I read an article an academic article that actually had the term dribs and drabs. And this was an attempt to try to justify the simple fact that Eugene Fama was not completely correct when he hypothesized that when a piece of information changes, then that change is instantaneously felt on the floor of the New York Stock Exchange. These authors of this academic article said there were dribs and drabs, that there's information and then the market reacts to it, but it's not complete information. And so there's a drib. And so, maybe a week later, a month later, there's another information release that clarifies the previous information release, or at least increases the clarity. And then you dribs and drab so that after, I don't know, a month or two, whatever it is, that you kind of figure that out. And so what that dribs and drabs has evolved into as this concept of low velocity, which is going to have an impact over longer time periods, and it might result in negative valuations, negatively affecting valuations. Now look at that last embedded bullet point there. Boy, did we ever state the obvious. Investors will demand higher required returns for investments in countries that are considered riskier. And remember now, we're not just talking higher political risk, which is pretty much what those previous CFA readings taught us. Now, what did I use that word earlier? Granularity. We're increasing. We're looking at this in different kinds of layers. So now the question is going to be not just political risk, but now which ones of these geopolitical risks are considered to be riskier? And once again, you ought to be able to make the conclusion that this is more complete. All right, how about the impact on investment here, on investment? So geopolitical risk must be translated into investment action. And that investment action might be inaction. I mean, let's suppose that your macro top-down approach in, let's say, the year 2019, let's say, was to say something like, I think that there are some industries and there are some companies in Ukraine that are undervalued. So let's allocate, 2 or 5% of the client's portfolio to some Ukrainian investments. All right, so think about this. So now we have COVID, and then we have the Russia and Ukraine invasion. And so what's going on there? Well, this clearly was a top-down approach that we made a poor choice back in, 2019, because we didn't complete our discussion of the possibilities of and the probabilities of a pandemic, and the possibilities and the probabilities of the conflict between Russia and Ukraine. Yeah, stable countries will have lower risk premiums. That makes perfect sense. This is so cool. Remember, we did these factor models. So we have a factor for size. Maybe we have a factor for book value versus market value. Maybe we have a factor for dividends. Maybe we have a bunch of different factors. But we can now summarize that geopolitical risk as a factor in our multi-factor models. And remember what that taught us. When we use these multi-factor models, they're going to tell us which factors are relevant, which factors are not relevant, which factors are priced appropriately, so that we can say something like, hey, you know what, we want to go invest in Ukraine, even considering, the conflict. And although I think in 2022, trading on the Ukraine stock market has been halted. Now look at that last bullet point there. Interdependence of countries may increase geopolitical risk for global investors. Okay, so that makes sense. Geopolitical risk in one country may have this spillover effect. So that takes us through our 4 learning outcome statements for this new reading. I really enjoyed this reading. In fact, I enjoyed reading this reading because it prompted me to go back and look at the CFA Institute, and I looked at that book by that Clement guy, and that was really fascinating stuff. So my advice to you guys, as always, is to read. Read the Wall Street Journal every day. Read whatever you can, because you learn something about reading. But go ahead and take a look at the 15 or 16 questions at the end of this reading. I will warn you that these questions, almost all of them are, which of the following? So which of the following is least likely? Which of the following is most likely? And so to be able to answer those are almost always definitional. There's some applications in there, but since this is a relatively new reading, I think that these questions are probably going to be on the simpler definitional side rather than the integrative side that we get in many of the other readings. So, hey, thanks for watching and have a great day and good luck studying.